Successful Minds with Patricia Baronowski-Schneider, the show that takes you around the world to share interviews with some of the most successful and relevant people on the planet. Hear their stories and get the most important business lessons they have learned on their road to success and get exclusive advice on how to implement their success into your life and business. Successful Minds with Patricia Baronowski-Schneider is brought to you by the Strategic Advisor Board and your host, Patricia Baronowski-Schneider.
Hey, are you looking to scale your business from 5 figures to 6 figures or 6 figures to 7 figures? If you are, I have the perfect thing for you. What I want you to do today is I want you to go download a book. This book is going to take you through my 3-pillar system. It's 100% free. All you have to do is go to growfast.cash. I say again, go to growfast.cash and you're going to be able to download my free international best-selling book, which is called Be Good, Be Brief, Be Gone. You can take that book. It's going to help you scale your business to the next level. Again, go download it. Be good, be brief, be gone. Growfast.cash. I say again, growfast.cash. Enjoy.
Hello and welcome back to Successful Minds. I'm your host, Patty Baronowski-Schneider. Today I'm joined by Jonathan Baird, an award-winning money manager. So welcome, Jonathan. Tell us a little bit about yourself.
I'm happy to be with you, Patricia. Well, as you mentioned, I had a long career in money management where I was fortunate enough to win several awards for having #1 ranked funds. More recently, I've been writing a monthly investment newsletter called the Global Investment Letter, which is about 7 years old now, a bit more than 7 years old, which deals with global markets and my interpretation of events that can affect investors and my comments on markets, as well as sharing with the subscribers my own activities in the investment world in terms of my positions and so on.
Right. Very nice. Yeah, I've worked because I do IR, PR, and marketing. So on the IR side, I've worked with many funds, around the world, ETFs, closed-end funds, ETFs, MLPs, BDCs, whatnot. But it is good because people want to get, a little global exposure. But you're right. If you're not in that area, you're kind of winging it. And the news tells you what they want you to hear, not exactly what's going on. So having someone who could give you some insights into, how this is affecting your trading is like a huge bonus. Yeah, good stuff. Now, you've managed several #1 ranked funds, including a Lipper Award-winning global equity fund in Canada. So what were some of the key factors that led to your success in managing these top performing funds?
I think one of the key things and what got me attracted to the investment business when I was a young man was a curiosity about what's happening in the world and interpreting various events, whether economic or social or geopolitical or what have you. I find that just intellectually very challenging and fascinating. So that has been a driver for me to always be reading and trying to absorb and accumulate general knowledge, which I think are successful traits for any investor. I think the other thing too that probably contributed significantly to my ability to sort of sustain superior returns is that my investment approach evolved over time, both as I gathered more experience as a money manager, but also in response to the changing world in which we lived. I started managing money in the mid-1980s as a very young fellow, and in the 1990s, and obviously subsequently after the internet bubble and so on, we've seen the world, and in particular in my field, the investment world, change substantially. And so what may have worked for me in, let's say, 1988 or 1989 would certainly not have worked nearly as well in 1999. And obviously, subsequently, the world has even changed more with the growing influence of technology in our daily lives, as well as the unfortunately deteriorating geopolitical scene globally. So I think being being responsive to change and being prepared to adapt and evolve is also a key attribute for investors.
Right. I think that's huge. I remember I was representing a closed-end fund at one point, and they were heavy invested in the financials, but in another country. And, it's good that you're on top of this, because I remember this particular manager really wasn't doing anything. It was kind of like they set it and forget it, and really wasn't, the fund wound up closing, which was unfortunate, but you're in that space. So it's up to you to evolve, keep up with the times, find out what's going on constantly, and manage the portfolio, which unfortunately not too many people actually do. So it's good that you're actually doing that. And that's, because like even say my mom, she has retirement income, she puts that in the trust of somebody, and you can only hope and pray that they know what they're doing, but you've been doing this for decades, which is a huge testament to, and award winning. I mean, that's huge. And, that's good stuff. So I guess, can you tell us a little bit more about the Global Investment Letter, and like what inspired you to start the publication? How has it evolved over the past 7 years?
Yeah, it kind of started somewhat serendipitously in that I started writing ad hoc posts on LinkedIn, just expressing my view of what's going on in the world of investing and so on, and that ended up generating a surprisingly favorable response and feedback from people on LinkedIn. And then one thing led to another, and that encouraged me, of course, to post more frequently because I'm getting positive feedback. And over time, people started to inquire as to whether there was a paid version that they could access for my opinions, as well as sort of more elaborate analysis and so on. And that gave me the idea for the Global Investment Letter. So the first issue was February 2017, after a good deal of teething and so on, just in terms of preparing the website and getting the format and so on, because I had never done anything like this before. So my learning curve was very, very steep. But it's been a very pleasant and meaningful journey in terms of me learning from the process as much as I'm attempting to convey what I know to subscribers. And so it's been wonderful, and we have subscribers in all the continents now, except of course for Antarctica, and so it's been great, and it's become a bit of a community of subscribers as well. I have some people that have renewed with me now for a number of years, so it's very gratifying and flattering as well.
Right. I think that's awesome, because you want somebody who, everybody always say, stay in your lane. I do this, I want to invest, but I don't have the time or the patience or the know-how to, know the, intricacies of what's going on everywhere, and, how that affects my portfolio and whatnot. So having someone like yourself that actually, this is what you do, this is what you love, this is what you're passionate about, and you actually do that legwork for me, I could see why this is a huge thing, because I actually know this publication just from being in the financial industry. So, that's awesome. Now, you stated that the global market considerations are having the greatest influence on markets since World War II. So what are some of the key economic and geopolitical factors that investors should pay attention to right now?
Well, I think that's true. That wasn't the case back when I started managing money. The world was, in retrospect, a far simpler place in terms of debt levels around the world were much lower. The geopolitical scene was much more straightforward because we were at the end days of the Cold War era. So we had a kind of a unipolar world situation where you had the United States and its allies versus the Soviet Union and its allies. And things were relatively simple in terms of attempting to decipher, the trajectory of events. But of course, that ended with the collapse of the Soviet Union, and also subsequently the rise of China. China, managed a remarkable economic transformation since the early 1980s to become the second biggest economy in the world. Why I think it has macro events has a much more important impact day to day on markets now than ever before since the end of the Second World War is the result of the collapse of the Soviet Union and the development of a multipolar world where you still have the U.S. and other Western nations with their values and particularly sort of democracy and rule of law, and then you also have autocratic nations like Russia and China that have their own spheres of influence and so on, and we're certainly seeing the ramifications of that with the Russian invasion of the Ukraine. There's a constant tension with China and its aspirations for retaking Taiwan, and then of course also in terms of economic issues, there's a tension between China and the Western nations that has been growing over the last number of years. In terms of economics, the financial crisis of 2008 ended up creating an enormous amount of debt, which I think was justified at the time because the alternative would have been a severe global recession. Unfortunately, though, the debt that was used to solve that problem, which I think was appropriate, was never actually pared back in the subsequent years of the 2010s when economic growth started to recover. And so we ended up then entering the COVID era, where once again, the monetary and fiscal response, I think, was perfectly legitimate. It was a unique threat to the global economy. And I think what various governments did in terms of supporting the economy was justified. But unfortunately, we have 2008, and then we've got the COVID era. And now, here we are in 2024, where most developed countries are still running enormous budget deficits, which is creating a record level of debts that the global economy has never faced before. Now, while I'm not suggesting that that's going to pose an imminent threat to, world civilization or anything, it is an issue that ultimately is going to demand the attention of nations around the world, because just unrestrained debt accumulation ultimately is going to create issues that governments will not be able to kick down the road by printing more money. And I'm not suggesting that is something that we need worry about today or tomorrow, but it's a lurking issue that isn't going to go away until it ultimately gets addressed. Mm-hmm. And then I would also point out too that the low interest rate environment that we've seen until recently, and now rates are coming down again, to me also points to the fact that the global economy, because of the debt and other factors, is relatively fragilely postured, and that the interest rate increases that we saw, in 2022, all it did was restore interest rates to more historic norms. Mm-hmm. Even though to a young person they might have seemed high, because many people have lived in an era of quite low interest rates. When I was a very young fellow, I can remember interest rates being close to 20% when Paul Volcker increased rates in the early 1980s to quash inflation. So that's what I call high interest rates. Mm-hmm. 6 or 7% to me is basically a long-term average. The fact that the world economy has had to rely on ultra low interest rates for a good part of the last 10 to 15 years, I think points to the basic fragility of the global economy that ultimately is going to create market volatility. And so it's something that I think investors or anybody with an interest in the world around them should be aware of.
Yeah, I mean, we always just say, it almost seems like the world is going down the toilet. I remember seeing a post 50 years ago, there was one income in the home. You could have 4 or 5 kids. Everybody went to college. Everybody had a car. Blah blah blah. Now you got 2 parents working. You could barely afford 1 kid. College, forget about it. It's like everything has just gotten to the point where it's the expense is just astronomical. I guess trying to aid towards the debt that we're in, but it's like it's not helping at all. Everybody, it's a tricky situation, but.
I mean, things have gotten more difficult. There's no doubt about that. And certainly, I'm a baby boomer, and baby boomers grew up in an era where they were incredibly lucky in terms of the economy and even talking about the Cold War, it was unpleasant, but it simplified the world, and everyone knew where they stood and so on. Mm-hmm. I would say though that I am not a doom and gloom person. I do think that the problems that we are facing, and they're real, can be addressed. And when you look back in history, compared to what our ancestors have faced, we're still incredibly, incredibly lucky. Can you imagine being born in the year 1900? Then you would have had to face the First World War, and then when that was over, you had a good time in the 20s, but then you had a major depression in the 30s. Then you had another World War. So, and then if you go back further, 500 years ago, people would be lucky if they lived to be 40 years old. So I am pragmatic, I'm a realist, but I also feel confident that the answers, to our problems are there. It's just that, how bumpy the road is and between now and how we solve them remains to be seen. But as an investor, I think part of my job is to, not only for myself, but now for the subscribers of the Global Investment Letter, to help them navigate that investment road, which I suspect is going to be a bit turbulent.
Right. No, I agree 100%. Now, you believe that the 2020s will be remembered for its volatility. So can you elaborate on pretty much what's driving this increased volatility and how investors can best prepare for and navigate these turbulent times?
Well, I started writing about that even before the Global Investment Letter started. That was one of my points that I was making in my early LinkedIn articles and posts. And it's sort of, here we are, getting towards the end of 2024. So we're not quite halfway. But I will say that you'd have to think that already the 2020s have been pretty volatile if you consider a global pandemic and interest rates, moving up, and, very weak markets in 2022. And then, of course, now the rise of artificial intelligence, which is, for better or worse, is going to be, I think, about as important as the internet in terms of having an effect on our daily lives. So I think we're already on track for that. In terms of markets, besides the geopolitical and economic factors, which I think are going to continue to produce volatility for markets, I mean, certainly, what is going to be the end game with Russia and the Ukraine and and China and Taiwan. The Middle East is escalating, which is unfortunate on a human basis, but could be very unfortunate on an economic basis if events really spiral out of control and affect the price of oil and so on. Mm-hmm. One of the things that I look at in terms of markets, and not only the U.S. market, but the U.S. market is the best example of this, is the enormous concentration that we're seeing in the hands of a small band of companies, which pretty well the Magnificent Seven group, which is over 30% of the S&P index. And when you have a small number of companies having such a large market weighting, if public sentiment starts to turn away from those companies and their share prices start to decline, which is typical of the end of bull markets. Bull markets through history tend to first offer clues that they're ending when the market leaders of that bull market start to underperform on a relative basis. So those companies, the Magnificent Seven, I think are a very good barometer on where we stand in terms of the broad trend of the markets. Mm-hmm. No bull market or bear market lasts forever. And I think that when the current bull market move ends, because of the concentration of the market leaders, the subsequent decline could well be fairly significant. And I'd also make the point, too, that bull markets through history, each bull market tends to have its own group of market leaders. Each bull market has a new group. And that's because bull markets tend to be led by some new technology or growth theme. And so back in the 19th century, you had canal stocks and railroad stocks and electricity and so on. Each of them drove markets in turn. In the 1920s, before you had the 29 crash, radio stocks were the AI stocks of the period. So at some point, companies like NVIDIA and so on are going to lose some of their market enthusiasm on the part of investors. Doesn't mean the companies are any less wonderful in terms of businesses and so on. It just means that from an investment standpoint, the stock price is not necessarily going to value them as highly. And so when we see that, I think that is going to produce a good deal of market volatility. And then, of course, finally, I don't want to belabor the point, but finally, the moves in interest rates and so on are going to have an effect on currencies like the dollar, the bond markets, and then the commodity markets also will, I suspect, prove to be a volatile place, both in terms of risk, but also opportunities in the years ahead. So all in all, this sort of mix is going to continue to create a period of market volatility.
Right. So now, since you follow all of this, so say, like when you say, stock prices going down, it could be opportunities. Like I know with like investing, some people say, oh my God, the stocks went down, I have to sell, but I always said on the IR side, but that's a buying opportunity. But since you're following that space, that's where you're basically able to kind of predict, okay, so this is going down because it's bad, walk away, but this is going down, but this is a great buying opportunity because the bull market's ending and blah, blah, blah. So, that's kind of what you're doing, right? You're just analyzing everything and you can kind of tell, I mean, obviously no one has a crystal ball, but you can kind of tell which one is the best to get in now, which is the best to get out now, which is the best to take a break for, all of that stuff, right?
Well, that's true. I mean, that is, I am not a buy and hold investor in terms of I just buy something and just, never sell it. Right. I mean, there's an argument that people will make for that. The argument that I would respond with is that if you're a serious investor and you pay attention, that you can maximize your risk reward by looking for opportunities to buy, but also indications and opportunities to sell if the market is no longer going your way. It doesn't mean that you can't buy back again at a better price. Okay. The other thing as well is that I encourage everybody to to try and adopt as broad a view of markets as they're comfortable with, in terms of looking not only in their own domestic markets, but look at international markets and even other asset classes. And so none of us are necessarily compelled to own any one investment.
Right.
You don't always have to be in the market if you're don't have a firm idea of something that you want to do, or you're feeling psychologically or emotionally uneasy about something. My advice then is just to step back and take a break, which is something that I practice as well, is that the psychological aspect of investing may be the dominant factor in how successful we ultimately are in investing, just as our own human psychology probably is the biggest determinant of how our own lives go, and how we look at the world and how we respond and how we manage our emotions. And so one of the interesting things about investing is it allows me also to incorporate a lot of other disciplines in the investment decision-making process. So that's part of what makes it interesting and also challenging as well.
Right. Now, you mentioned that investor psychology, it plays a powerful role in determining success. So can you share some insights into common psychological traps that investors fall into and maybe how they could avoid them?
Yeah. I mean, I've been, I'm sure, guilty of all of them. We're all, to be human is to be fallible, and I'm all too human. One, there are quite a few. One is just recency bias, it's called, and then basically it's the tendency of people, human beings, just to believe that what's happened recently in history is going to continue indefinitely. So, we had a period of very low interest rates. Well, I'm sure that some people were shocked when interest rates got as high as they were, and that's true. In terms of trends, we've had a long bull market. It doesn't mean the bull market's going to stretch out into the horizon, but the same is true of bear markets too. When you get into a period where stocks are weak or the economy is weak, it doesn't necessarily mean that that's going to occur, indefinitely. In fact, it's probably not. Other things that I see that are very common is somebody will buy a stock, let's say at $10, and it goes down to $5. Well, the people, I've heard this so many times over the years, says, well, I'll sell when it gets back to $10, because they don't want to incur a loss on the position.
Looking to grow your business beyond 5 figures, 6 figures, 7 figures plus? What I want you to do is go download this book. The title is called Be Good, Be Brief, Be Gone. It will help you grow your business past 5, 6, and 7 figure. Go download the book today, growfast.cash. I say again, growfast.cash, and download the book for absolutely free.
Now, there's no guarantee that the stock is going to go from 5 back to 10. The stock doesn't know you own it and you're feeling bad about losing money on it. It could go to 0 theoretically, or at any price between 1 and 10. And so that is an example too, where a valuable tool in investing from a psychological standpoint is to be able to admit or realize that we're wrong about something and move on from it and put it behind us and not to dwell on it. That's another thing which is true in investing as it is in our daily lives is, we've all made mistakes and we've all had tough times. If we can learn what we can from them, but if we can put it behind us and not dwell on dwell on it and make ourselves suffer even more for no reason, then I think that's not only healthier from a psychological standpoint, but it's going to produce better investment returns as well.
Right. It's so hard to take the emotion out of trading, because I remember years ago, I was day trading. And I remember, when I started out, they had the paper account where you're playing with pretend money. And it's like, I could have all this money. Oh my God, I just made, 10,000 today. And then it drops. I'm like, oh my God, I got to get out of it. And then it goes back up, and I'm like, I'm doing the complete opposite of what I'm supposed to do. I'm buying high, selling low, but I've seen people lose their houses because now once you lose, like, I got to make it back. I got to make it back. Yes. And they go back. So that's why sometimes it's better to leave it to the pros, because it's very hard. Like when I had the paper account, I had let it go. And I looked back on it like 2 years later, I'd be a millionaire today if I would have just took my emotions completely out of it. But hard to do when it's your own money. So I get it.
I mean, that's very true, and that's very human. And we've all felt that, including myself. But I guess one of the products of my experience has been that I've learned how to divorce myself from that. It doesn't mean that human emotion doesn't rear its head in my own activities from time to time, but I try and be aware of it and check how I'm feeling and behaving, which is something that I think is a good idea for all of us. It's not always easy, and a lot of what's best in terms of investment approach is actually quite counterintuitive to how we're wired as human beings, emotionally and psychologically. As humans, we have a tendency to want to follow the herd. Well, that is the exact wrong thing to do most of the time with investing and so on. So that's one of the challenges of investing, is to master ourselves, which ultimately maybe is the hardest thing in life.
Right. But you're doing it the right way too. You're following, patterns, you're following the news, you're following the markets, you're following statistics and all, factual things, where instead of me just following, oh my God, I feel bad, I feel good. I mean, that's, it shouldn't have a place in there. So.
Well, I also had the luxury of doing this full time. So that's an advantage. That's an advantage too, is that, I've been able to devote, since for a long time now, my attention to the task. For somebody that has a career and so on, is attempting to keep track of their investments, in addition to it, that makes it even more challenging. So, I mean, I'm sort of very sympathetic to that, and that's one of the things or services that I attempt to address in the Global Investment Letter. Is I'm attempting to offer subscribers an opportunity to look over my shoulder, so to speak, in terms of what I'm doing, and take from it what they will, and feel free to disagree as well. I mean, all I can offer is my opinion, and which is, I guess, true of us all.
Right. Yeah. Good stuff. Now tell us, what are some of the pragmatic rules of thumb that you found useful in mitigating risk while still maximizing returns? And can you share some examples from your experience?
There are a couple. One is position sizing, in terms of how big your investment position will be. I have what I would call a full position, which is a set percentage of the overall portfolio, and then I'll have increments of smaller positions. Depending on my level of conviction for a trade, or also what I deem to be the risk-reward parameters of the investment idea that I'm going to implement, I'll either take a full position initially, or I'll take a smaller half position, let's say, and see how the position does, and then I may increase the position or exit the position altogether. The other thing that I advocate, which I talk about in every issue of the Global Investment Letter, is the use of what I call protective sell prices, where when I establish a position, I will also calculate a price level at which I believe the market is telling me that I'm wrong about this investment idea, and I'll set the price accordingly. I tend to use a combination of both fundamental and technical analysis, and the technical analysis tends to play a larger role in helping me set the protective sell prices, because I'm looking at key points in the chart, whatever market it is. It doesn't have to be stocks. It could be commodities or currencies or what have you. And if it's telling, there are some key points in any chart that will give a very good idea of whether we're seeing a change of trend or a meaningful change of investor sentiment. So I'll set the protective sell prices accordingly. The idea is that I'm attempting to minimize my potential losses in a position to, typically at most 3 to 5%. And while, if I'm successful in a trade, letting the profits rise until there's evidence in my mind that there is a change of trend. Mm-hmm. So the idea is maximize the gains on your winning trade, minimize the losses on your losing trades, because inevitably you're going to have a segment of your trades are just not going to work out for whatever reason. Mm-hmm. And if you do that consistently, you'll produce very good returns. And in fact, if you do that, you don't even have to be right 50% of the time to make money, because the gains versus the losses are skewed in your behavior, in your favor. Mm-hmm. And so that's what I try and do. And lastly, try and think in terms of probabilities, try and calculate the probability of events happening and so on. And if you do that, if you try and play with the odds in your favor, that also will, I found, being very, very helpful in investing as well, and mitigating risk. And risk mitigation is probably, the number one thing. As Warren Buffett, I think, said, to win, you must first not lose. And I think that, I think it was Warren Buffett anyway. I think there's a lot of wisdom to that
for sure.
saying.
Yeah, I agree 100%. But I like how you mitigate the loss, because, you have to know how to do that. And not everybody does. So that's why sometimes leaving it to the pros is key. But there are ways that you can mitigate the loss, stop losses or whatever the case may be. And
yes,
some people don't understand that. They're just like, oh, I put this money in and the stock went down. Yeah, but it doesn't mean you have to be in it,
Well, that's right. There are things you can do to to reduce your risk exposure.
Right. Yeah. And tell us, what global macro trends do you foresee shaping the future of the markets over the next few years, and how should investors adjust their strategies to take advantage of these trends?
Well, I think the evolution of technology is certainly with us in spades, and is going to only grow as a factor, not only in our daily lives, but as investors. So I would be, as an investor, I would attempt to be as alert to evolving technology and trends as I can be, because I do believe that's likely to be the market leaders for future market moves going up. There are other trends that I think are important. The defense companies are a core long-term theme for me, and it has been since the first issue of the Global Investment Letter, because of the geopolitical situation that we discussed earlier on our talk. I think that there's going to be increasing demand for military spending. And in addition to that, the evolution of technology is also creating demand for new upgraded military hardware, because more and more military conflict is being determined by who has the best technology and weapon systems at their at their exposure, and so the actual size of armies in terms of number of troops in the decades ahead is probably going to decline, but the amount of money spent on technology and weapon systems is only going to increase. So that's an area. I think that healthcare remains a core theme for me. The baby boomers are aging with every passing day, and that's going to create more and more demand for healthcare. And similar to the defense comments, you're not only seeing demand in terms of the aging population in many Western countries, but you're also seeing evolution in medical technology as well, not only in terms of hardware and systems to monitor health and so on, but also in the development of drugs and so on. So that's a growth area that I see, that I think all investors should take advantage of. That's not to say that I'm necessarily exposed to all those areas all of the time. I'll take opportunity to buy when I think there's a buying opportunity, and there'll be times when I think the risk reward is not in my favor, and I'll take money off the table. And lastly, I would pay attention to emerging markets. Large emerging markets like India, I think, offer tremendous growth looking out in the decades ahead. Not only India, but I use that as an example because it's so large, but other emerging markets have enormous economic leverage that, as long as the respective governments can stick to adopting free market or economically friendly policies, then I think the growth potential there is enormous. The big caveat for emerging markets, as well as probably for any market, is just be careful about, adverse developments in terms of the local politics. If countries start no longer respecting the rule of law or implementing other policies that are not conducive to economic growth, then I would exit those markets. Right. And so those are, I guess, three big themes that I see that are probably going to work for probably another 20 years.
Nice. Now, how do you think the current geopolitical risks, such as tensions in global trade, political instability, and energy crisis, will impact the markets? And are there any specific regions or sectors that you believe are particularly vulnerable or poised for growth?
Well, the one thing that I am concerned about is the rising talk about tariffs. Because I'm an economic conservative, and because I support free trade and free markets, I'm dead set against tariffs. And the reason I am is because historically they've stifled economic growth. One of the reasons that why the Great Depression in the 1930s was as bad as it was because after the market crash in 1929, governments, in an effort to wrongly protect their local economies, implemented a round of fairly punishing tariffs, which ended up just stifling and collapsing global trade. That ended up lifting as we got into the late 30s with the approach of the Second World War and so on. So that is a big concern to me. There is some small legitimate role for the use of tariffs on particular situations that are particularly critical, but by and large, I am for free trade. That's how the global economy and the world and we as a civilization ended up prospering over the last 2,000 years, was the ability to trade and exchange goods and so on. That is a concern. The Middle East, the Middle East has been, a source of worry and a source of contention since, well before I was born and probably going back centuries. It's difficult to see an easy solution to the problems, just because the level of mutual antagonism in the region is so high that I don't think any of the parties can really respond to a cool-headed, rational argument. The tempers are so elevated. There's the potential there, if Iran ultimately takes a larger role than it currently is in the Middle East, to see a real escalation of violence as well as economic instability if the Iranians try to choke off the Strait of Hormuz or something which is where a lot of Arabian oil goes through. Now, I don't think that the choking off would last very long, because I think the United States and its allies would probably address that situation, but it would create a spike in oil that could have a lot of both intended and unintended consequences. So we live in a world where the trajectory of geopolitical events is continuing to deteriorate, which is creating increasing uncertainty. And uncertainty is always an aspect of our daily lives and certainly of investing. But the level of uncertainty and the potential ramifications for the effects of adverse events are higher now than they have been, as I've said, since the end of the Second World War. So it's troubling, but at the same time, the volatility I expect, while it's going to present risks, is also going to present great opportunities for investors, because volatility does that. Volatility does tend to create extremes in markets, and those extremes can produce some very attractive opportunities for investors. So while I'm worried as a citizen, I'm somewhat excited by the prospects that I think will be offered to investors in the next 5 years or so, because of the volatility I anticipate.
Oh, good stuff to think about. Now tell us, with decades of experience in global markets, what advice would you give to someone just starting out investing? And are there any specific skills or mindsets that have helped you in your career that you think are essential for new investors?
I think the number one thing is read a lot. Read about not only investment matters, and there are some good, there's probably 5 or 10 good books on investing that, to my mind, are essential reading. And I think with a bit of poking around, you can identify them. I think that's one thing, and that would be number one. That certainly was the route I took. And beyond that, expand your reading to read history, keep up on geopolitics, because it's all ultimately connected. What happens in the oil market or interest rates is going to affect the dollar, and what happens with the dollar is going to affect markets around the world, and so on. So I would say, before you do anything, read as much as you can, develop a sense of what kind of investor you are in terms of your own risk tolerance, your own preferences as an investor. There's an old saying I read in a book that was published in the 60s, is that if you don't know who you are, the stock market is a hard place to find out.
Yes.
And that gets back again to our psychology. It's a bit of a journey in knowing yourself in terms of investing. And so try and prepare yourself for the task as much as you can before you even start. And then I would say start small. Paper trading's okay, but there's no replacement to actually putting real money on the line. And it's much better to risk $1 of real money than to spend years paper trading, because just the very fact that you've got something tangible at risk really serves to focus the mind, and it'll tell you also what your emotional reactions are and so on. So I would, but I would say start small. Bear in mind risk, and try and use some of the risk mitigation tools that we talked about earlier in our talk and so on. And if you do that, I think that the process over time will be less painful than it could be otherwise.
No, good stuff. I mean, I know it's so hard to get them up, but you're right. Start small, so you not like you lost 5,000. You lost $50. You're okay.
Exactly. Yeah. And then, as time goes on and you develop confidence and you develop experience, right, then you can, raise your level of exposure. Right. But it's an old saying, but it's true. And nobody appreciates it when they're young, but you do when you get older, is that, there's no replacement for experience.
Absolutely. Yeah. Now, anything else you want to talk about that we didn't cover? And just to touch, people, they don't have to be in a specific state to work with you. They could be around the world, right?
I've got subscribers all over the world. I cover markets all over the world, and investors now, no matter where you are, you can invest in any market, anywhere, anyway. Right. If they want to see some sample issues of the Global Investment Letter, I offer that on my website, which is globalinvestmentletter.com, and there'll be up in the right-hand corner, you can click on sample issues, and you leave your name and email address, and then you'll also receive a weekly market commentary that I put out, which is free. That comes out Tuesday afternoons, and you don't have to keep receiving it. If you want to unsubscribe, you can unsubscribe anytime. But I do offer the sample issues and then the weekly commentary, which will also allow people to get a bit more comfortable about my thinking, and I also share sort of, something timely that's going on in the world and so on. So yeah, I would, and there's some other resources on the website as well for people to explore and so on.
Nice. So how can people get a hold of you or learn more about you?
Globalinvestmentletter.com is the website. I have a LinkedIn profile where I still post, and that's just Jonathan Baird CFA on LinkedIn. And so the website's the best way to reach me, because it's got all sorts of contact. You can contact me right through the website.
Awesome. Well, thank you again for being on the show. Again, that was Jonathan Baird. So thanks for listening to Successful Minds with Patty B. Never miss an episode by subscribing to the channel. So thank you again.
Hey, we all want to scale our business. Hey, I have the answer for you today to help you do that. If you're looking to scale from 5, 6, even 7 figures and beyond, book called Be Good, Be Brief, Be Gone. I'm going to give it to you for free. All you have to do is type in growfast.cash. I say again, growfast.cash, and you can download the book for absolutely free. I hope the book helps you this year. Take your business to the next level. Again, go grab the book, growfast.cash. I say again, growfast.cash. I wish you the best and grow, scale, and win.
Thank you for listening to Successful Minds with your host, Patricia Baronowski-Schneider. Please leave your feedback and visit strategicadvisorboard.com to get the latest and greatest business advisement on the planet. Follow us on social media for updates, and we'll see you on the next episode.
There it is. Magnum. Holy moly.
Yeah, baby! That's what I've been waiting for!
Dear God.